Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Friday. It's September 9th. Where is this year going? September's already a third over. It's about 7:55. I'm having an early start. Market's going to open up in about an hour and 35 minutes to be specific with you. And by the way, if you're enjoying these videos, if you have questions for me, you don't even have to send me an email if you don't want to. Just post comments below this video and I'll answer it for you. Or send me an email at support@marketgeeks.com. Would love to hear from you. One way or the other, let me know if you're getting any benefit from these videos. Just post below. I spend 15 minutes a day on these things. Anyways, let's start off. It's Friday. We'll do a weekend review or a week ahead review or a review of the week. Let's just get into it. So the Dow Jones up 224 points. The Nasdaq is up beyond random, and the S&P is definitely meeting us in between. Now, what were the biggest clues that this was going to rally, that the market was going to rally? Let me show you. As I've been telling you, it's been the bond market. The fact that the bond market went down here and diverged, and now looks like it wants to come back up again. It went down yesterday, but it didn't break the low. And this morning it's up 0.6%, not 0.6%, it's 0.60%, but it's 0.65 ticks to the upside. And you don't need to watch the TLT. A lot of people are asking me why I look at the TLT. You could look at the futures if you wanted to. You could look at the indices. And if you wanted to, you could look at let me give you the financials here. You could look either at the 30-year or you could look at the 10-year. They're both very, very highly correlated. And as you could see here, they're doing pretty much exactly the same thing as the, here, let me give you a chart. Just down and to the count and 30-year. Let me show you the 30-year. These are, this is what the TLT tracks, the long bond. So you could see here how it shakes out here. There it goes. See, there's that downtrend and there's that channel we've been talking about. Let me draw it for you. But a lot of people are like, Roger, how come you're talking about TLT and not the bond market? Well, the 30-year and even the 10-year, see that? And then look at this. Right? It's very close. So the divergence that we're seeing, and I'll show you, you can't really see it here, but you can, in fact, see it here. Let me show you here. You see how we go lower here? We're going higher here. Very, very, very significant. Another major, major clue. I want to give you all the clues so you could see how we figured this out. Another major clue that we were going up instead of going down was volatility. Volatility via the VIX, via the ATR, it stopped reacting to the market. And I was actually showing you guys this. See, volatility, see that? Volatility is not really reacting. If you look here, and I want you guys to see this because this is really important. So if you look at settings, and if you go to display and you go to small, you will see that anytime the market goes down, this is volatility. Look, it goes from 469 points to 749 points. The market drops, goes from 34,200 to 31,100. Volatility goes from 386 points a day to 469 points a day. Here it goes from 460 to 760. Here it goes from 400 basically to 470. Not a major change in volatility. That was a huge, huge clue. So I think we're going to continue going higher. We're right at the 50-day moving average. I think we're going to break higher. And I think we're going to see some resistance when we get back to this level here, which is right at the 33,400 on the Dow. On the QQQ, let me just give you these levels that I'm expecting resistance. I'm expecting resistance at the 315 level on the NASDAQ, and on the SPY, we should be seeing it right around the 418 level, or the 418 level or so, right below the 200-day moving average. So again, that's when I believe the next resistance level will be. Interestingly, if you look at consumer discretionary stocks, they have starved off, and this resistance is becoming support. And that's huge, huge, huge because consumer discretionary has in fact been the weakest sector. So if this can stay above here, that's going to mean quite a bit. And if we can trade above the 200-day moving average and stay there, that's huge. But for consumer discretionary, the next major resistance level is 172. These levels that I'm giving you are very important. If we break these levels, there's a good chance we're going to go through. In terms of Fed data, we had international trades in goods and services. They were good. We had jobless claims, and then we had Mr. Jerome Powell speaking yesterday. So you guys all know how I feel about him, but let's talk about global economy, and we'll kind of trickle into the small stuff afterwards. Federal Reserve Chairman Jerome Powell, Mr. Jerome, I won't tell you what I really think till I get reappointed, Powell, assured markets that interest rate increases will likely be within expectations. Well, I don't know. The market turned and people thought we were going to go back to 0.25. I think we're going to stay at least 0.5, 0.75 two more times. China has been releasing a lot of economic data with more expected next week. Interest is high because China is the biggest exporter and the second biggest economy in the world. Their zero COVID policy has, in fact, impacted economic activity by a big, 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 big margin. Investors are also eyeing interest rates as European central banks make its largest ever increase to fight inflation. It's about time. And we need positive interest rates in Europe as well. I mean, this negative interest rate business isn't going to get us very far in the world. Investors also heard from Mr. You-know-who reaffirmed that central banks' commitment to keep rates high as long as necessary to get inflation under control. Some market observers remain skeptical. I don't know why. I mean, it's pretty cut and dry. On the same day the European central banks delivered its big rate increase, Powell told a conference on monetary policy that the Fed will keep rates high until the job is done, getting inflation to 2%. We're not anywhere near there. The Fed has already raised rates 4 times this year, and market expects and prices in a delivery of another jumbo-size increase of 0.75 of a point in 2 weeks. Folks, that's priced into the market. And crude oil is kind of, doing its thing, not really doing anything. As you could see here, cumulatively speaking, utilities, energies, healthcare. Remember I told you healthcare and consumer staples, they're pretty safe as far as defensive stocks. They're both coming up. These are the sectors that you really want to focus on. And industrial too, to a point, unless there's a recession. But consumer discretionary, it's going to be very interesting if it pulls up technology and communication services, or if technology and communication services pull consumer discretionary down. And again, that one is really important because it's right at that level. And if it breaks lower, it's going to push the rest of the market with it. But, here's the big but. If the bond market can sustain these levels and go higher, we will get out of this in one piece. So you got to keep an eye on the bond market. Very, 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 very important. Volatility via the VIX is now back within this channel, which is very important, and it looks like it's going lower. If this is going lower, that means there's a higher chance that the stock market will go higher. Put to call ratio is still inflated. We're only at 97 right now, or 100. So there's way, way more put buyers than call buyers, even with the market doing what it's doing. Now, getting into specifics here with you. Notice this is starting to get green again. I like it, but look at financials, 29%, 77%. Now, energy I like, 81, 86. That looks good. Utilities I like, 93, 93, 97, 100. That's a foundation. But look at some of these that are gaining higher. 77, 29, Consumer discretionary, 19. That's what I'm afraid of. Too much, too fast. So you've got to be very, very, very cautious, especially in light of the fact that only 25% of stocks in the NASDAQ 100 are trading above the 200-day moving average. And in the NASDAQ composite, only 28%. So we have a huge amount of vulnerability. So even though consumer discretionary is just kind of sitting here, and there's a question of whether it's going to go higher. Honestly, in my opinion, I think bonds are going to go higher. This will take us a little higher, but then it's going to break down. Why? there's just not enough. There's just not enough consumer discretionary stocks to hold the market to go higher. And if you look at it on a long-term basis, it looks like we're just gaining some strength now. So this is a huge level of vulnerability that we got to take into account. This can go either way. Very vulnerable. So we got to be very careful. Now, today's Friday. What do I always do Friday? I always talk about algo. Now, a lot of people think algos are very complicated, but they're not. For example, here, you see this? 6-month high, 3-month high, 1-month high. That's a very basic algo system for you. We pick stocks that are making 6-month high, 3-month high, 1-month high percentage, then we're dividing it, and that's the cumulative basis. So it doesn't have to be complicated. Here's another example. Let me show you. Here's an RSI going above overbought, oversold, overbought, oversold. That's a very simple algo, okay? So algos don't have to be complicated, and you don't have to make these things complicated. Oversold, overbought, oversold, overbought. The point is, most algos have less than 5 rules, okay? Very important. Now, as you probably know, I'm an algo trader. That means I mostly use algorithmic strategies that I build, test, and optimize to trade the markets. Now, it helps me remove emotions from trading, simplifies trading, and I believe makes me more consistent trading during these crazy market conditions. That's why today at 1 p.m. Eastern Time, I'm going live. I'm hosting a free training session on algo strategies that I think traders need to know about more than anything. And just for joining me today, I'm going to give you my #1 play that it's signaling. Just use the link below to reserve a seat for the event. And I hope to see you there. Do not miss out and post comments in the feedback. Bye, guys. I'll see you soon. Have a great weekend. Bye.